You know that feeling when you're just scrolling online and suddenly you see someone showing their investment portfolio. Big numbers, clean charts, everything looking perfect. And for a second, your stomach just drops because you start thinking, wait, am I behind? Yeah, most people don't say it out loud, but they feel it. But here's something even more uncomfortable. The reality for the average person? It's actually worse than you think. Like, way worse. When you look at the real numbers, you start to realize that a lot of people aren't just a little behind. They're heading in the wrong direction completely. And that's the part nobody really talks about. But here's the good news. You don't have to end up there. In this video, I'm going to show you what's really going on, the actual numbers most people ignore, and more importantly, a simple, clear plan you can follow to make sure you're not part of that story. All right, let's not sugarcoat this. You might feel like you're behind financially, but when you actually look at the numbers, it's honestly shocking. The reality is, most people are not doing as well as they seem. For example, when you look at real data on retirement savings, the typical household has around $87,000 saved. And I know that might sound like a decent number at first, but here's what most people don't realize. That number is the middle, which means half of the people out there have even less than that. Let that sink in for a second, because it completely changes how you see things. And it gets even more uncomfortable when you start breaking it down by age, because that's where the real picture shows. Now, it gets even more real when you look at specific age groups. If you're between 35 and 44, the typical amount people have saved for retirement is around $45,000. Yeah, that's it. And this is the stage where you're supposed to be, earning more, building momentum, really getting ahead. But instead, most people have less saved than what it costs to buy a brand new SUV. Just think about that for a second. Years of working, years of earning, and the savings don't even match a single big purchase. That's when you start to realize it's not just about how much people earn. Something deeper isn't working. Now let's move up a bit. For people between 45 and 54, the typical retirement savings is around $115,000. Better than before, sure, but still not where you'd expect it to be. And then you get to the group that's closest to retirement, ages 55 to 64. You'd think this is where things really come together, right? But the number is only about $185,000. Pause for a second and really think about that. This is a stage where retirement is no longer far away. It's right there. And yet, the savings don't reflect that reality. Because when you hear what experts usually recommend, it's often around $1 million or more to retire comfortably. Now compare that. Most people aren't even close. In fact, they're not even a fifth of the way there. And that's when it really hits you. This isn't just a small gap. It's a completely different reality. And it's not just retirement accounts. Let's talk about something even more basic. Cash. Right now, the percentage of income people are actually saving is around 4.5%. That's it. And maybe that number doesn't sound too crazy at first, until you compare it. Because historically, people used to save about 8% or more. So what does that really mean? It means we're saving almost half of what people used to. At a time when things are more expensive, life is less predictable, and the need for financial security is even higher. So instead of saving more, we're actually saving less. And that's where the real problem starts to show. So if you've been sitting there feeling like you're behind because you don't have a six-figure portfolio yet, take a step back for a second. Because the truth is, most people aren't ahead. They're barely holding things together. From the outside, it might look fine, but underneath, a lot of people are just trying to keep up. And slowly, without even realizing it, they're heading in the wrong direction. Not crashing all at once, just drifting little by little. And that's the dangerous part, because it doesn't feel urgent. It doesn't look like a problem until it becomes one. But this isn't about making you feel better by comparison. It's not about saying, at least you're not the worst, because that's not a strategy. Being slightly better than a bad situation is still a bad situation. The real goal is simple. to be financially secure, to have control, to have options. And right now, the path most people are on doesn't lead there. So the real question is, why do these numbers actually matter? Why isn't this just a small problem? Something people can fix later? Why does it feel bigger than that? Because when you really break it down, it points to something much more serious. Not just a small gap, but a system that's quietly failing a lot of people. And it all comes down to a few hard truths, the kind most people don't think about until it's already too late. First up, the silent killer of wealth, inflation. That cash you have sitting in a standard savings account, it's losing value every single day. The national average interest rate on a savings account is a pathetic fraction of a percent, currently around 0.59% APY. Meanwhile, even a modest inflation rate of 2 to 3% a year is like a termite, slowly eating away at the foundation of your buying power. In 10 or 20 years, that $87,000 median retirement fund will buy you significantly less than it does today. Holding cash is not a safe strategy. It is a guaranteed loss. The second reason this is a disaster is the myth of, I've got plenty of time. When you're in your 20s or 30s, retirement feels like a lifetime away. You think, I'll get serious about it later. But the single most powerful force in finance is compound interest, and its fuel is time. Every year you delay is a year you rob from your future self. The money you invest in your 20s has over 40 years to grow. The money you invest in your 50s has maybe 10 or 15. The difference isn't just big. It's a multi-million-dollar error over the course of a lifetime. Third, there's a massive gap in financial understanding. A staggering number of people simply don't get the core concepts needed to build wealth. They hear terms like index funds or asset allocation, and it sounds like a foreign language, too complex, too risky, like a club they're not invited to. So what do? They do nothing. They stick with what they know, a low-yield savings account, and a hope that things will just work out. But hope is not a financial plan. Finally, the system isn't set up to help the passive. While recent data shows around 62% of Americans own stocks, often through retirement plans, the distribution is wildly unequal. The wealthiest 10% of households own a staggering 93% of all stocks. The bottom 50% of Americans, they own just 1%. The wealth-building machine of the stock market is running, but most people are just standing on the sidelines, watching the train leave the station. When you combine chronically low savings, the wealth-destroying power of inflation, a delay in starting, and a general lack of financial literacy, you don't just get a difficult situation. You get a ticking time bomb. You get a generation of people who will be forced to work well into their 70s or 80s, not because they want to, but because they have no other choice. That is a disaster we are facing. If you're finding this helpful and maybe a little terrifying, do me a quick favor and hit that like button. It's a small click for you, but it tells the YouTube algorithm that this is a message people need to hear. It helps get this crucial information in front of someone who might be on that collision course and doesn't even know it. Thanks. Okay, that was a shock. Now for the solution. The good news is avoiding this fate isn't complicated. It doesn't require a finance degree or a six-figure salary. It just requires a plan and the discipline to stick to it. Here is the simple 3-step plan to ensure you are never, ever average. Step 1, master your savings rate. This is the most important number you will ever track, especially in the first decade of your journey. It's even more important than your rate of return. I'm going to say that again. How much you save matters more than how well your investments do, especially at the beginning. Your goal should be to save and invest at least 15% of your pre-tax income. If that sounds impossible right now, don't panic. Start where you are. Can you do 3%? Start there. Next month, try for 4%. The key is making a priority. Treat your savings like a bill you have to pay. In fact, pay yourself first. Before you pay for rent, groceries, or Netflix, transfer that money out of your checking account. Automate it. Make it non-negotiable. Every time you get a raise, increase your savings rate before you increase your spending. Don't let lifestyle creep eat away your future. Your savings rate is the engine of your wealth. Step 2, make your money work for you the right way. Remember how we talked about cash losing to inflation? The antidote is investing. But I'm not talking about trying to pick the next hot stock or timing the market. That's a fool's errand. I'm talking about the most proven, simple, and effective strategy for building long-term wealth: low-cost index funds. An index fund is just a basket that holds tiny pieces of hundreds or even thousands of the biggest companies. An S&P 500 index fund, for example, lets you own a small slice of the 500 largest companies in the U.S. Instead of betting on one company, you're betting on the entire American economy to grow over time. Historically, that has been a very, very good bet. Over the long run, the S&P 500 has returned an average of about 10% per year. You don't need a lot of money to start. That's a huge misconception. You can open an account with a major brokerage and start investing with as little as $50. The barrier to entry is gone. The key is to put your savings into these funds instead of letting it rot in a savings account. Even the best high-yield savings accounts are offering around 4% right now, which is less than half of the stock market's historical average. You're leaving money on the table by being too safe. True safety is growth that outpaces inflation. Step 3, automate everything. This is the final piece of the puzzle. This is the secret that ties it all together and makes you a disciplined investor without needing superhuman willpower. You need to set up an automatic system that runs in the background so you don't even have to think about it. Here's what it looks like. Every payday, you have an automatic transfer from your checking account to your investment account. Once the money arrives, you have an automatic investment set up to buy your chosen index fund. That's it. You set it up once, and it runs forever. This process is called dollar cost averaging. When the market is high, your fixed dollar amount buys fewer shares. When the market is low, that same dollar amount buys more shares. It forces you to buy low and be disciplined, removing all emotion from the process. You're not trying to guess the market's next move. You're just consistently buying month in and month out, year after year. This is the secret of the everyday millionaires you read about. They weren't geniuses who picked the next Tesla. They were teachers, plumbers, and engineers who lived below their means, saved a big chunk of their income, and automatically invested it in boring, simple index funds for decades. They built their wealth through consistency and automation, not brilliance and complexity. The numbers are clear. The average person is on a path to financial hardship. Their savings are terrifyingly low, and their strategy, if they even have one, is fundamentally broken. They're playing a losing game against inflation and time. But after watching this video, you're no longer average. You know the truth. More importantly, you have the solution. It's a simple 3-step plan. 1. Focus relentlessly on increasing your savings rate to 15% or more. 2. Put that money to work in simple, low-cost index funds, not a savings account. And 3. Automate the entire process so your wealth builds itself in the background. This isn't flashy. It isn't a get-rich-quick scheme. It is a get-rich-for-sure plan. It requires discipline and patience, but it is the most reliable path to financial security and freedom. You have a choice to make. You can be average, or you can decide, right now, to take control of your financial destiny. The path is clear. The choice is yours. Thanks for watching. If you want to keep learning how to build real, lasting wealth, go ahead and subscribe to the channel. And check out this next video on the screen now, where I break down exactly how to open an investment account and buy your very first index fund. It's the perfect next step. See you there.